But we've got Inderjeet Singh Bhatia from Macquarie Capital joining in to talk about where the market is headed from here. Inderjeet, hi, morning. Good to have you on the show. A decisive mandate by the government, all get up for NDA 2.0. But again, it's the same feeling that you had almost 8 months back, wherein the index is doing all very well, sitting at all-time highs. But again, individual portfolios, mid-cap stocks, they continue to bleed. So again, you're having that missed out feeling, and you're not feeling as joyous as you would have if there was a more broad-based participation. Do you sense that's any time in the coming, or would you say that it would be the same story for some time to come?
Yeah, hi, good morning. Thanks for having me on your show. I think on the market, the broad-based market, definitely some value is emerging, though we are starting to turn more cautious on frontline indices. There is a natural euphoria around the new government coming in. We think that euphoria will start to kind of die down in the next few months, especially after budget gets announced and it kind of gets back to as usual. Market will start to focus much more on earnings and what's happening on the economy, which unfortunately at this point of time does not seem to be a very, very rosy picture. We also have a set of problems to deal with, especially around liquidity and around what's happening with NBFC. So I think those will start to, and I think they've already started to occupy the central space in that ways. And the government's own agenda that will start to emerge only after budget, I would say, or around budget at that point of time. So we will be still continue to remain cautious on the market.
Yeah, exactly. Like you said, that it's going to be a tough tightrope walk that Nirmala Sitharaman in her first budget that she's going to be presenting as the finance minister would have to take. What is it that you're expecting on a policy stance from the current regime, given the decisive mandate that it's had? Because, it is a sticky spot. I don't know what really the budget can emphasize on or could emphasize on to be able to garner more revenues.
So honestly, we don't think budget is a make or break event, as some sections always like to make it out. What the simple message I'm trying to take from the budget is how serious is the government about, or what is the view of the government about the seriousness of the economic state right now? Are they really worried, or they think that this is only a passing phase? And the government's reaction will depend on whether they think we are in a crisis mode or not. So I would look forward to budget to glean through those kind of messages. My view is the government does not have too many options. They would have to continue spending big on infrastructure. They would have to somehow find ways to boost real estate and in the meanwhile still garner more revenues. So I would anticipate more implementation, more measures on the GST front, where there has been a decent amount of leakage which is happening in the last 2 years. The compliance has been fairly soft because of the impending elections. We think that will start to change in the current financial year.
Okay, so is that then reflected in your outlook on growth as well, Inderjeet? And when you say later this year, is it a couple of quarters away? How concerned are you with regards to those slowdown fears and their impact on resulting sectors as well?
I would say that market seems to be now prepared to see another quarter of slowdown, but they kind of heavily buying into the story of second half turnaround. Unfortunately, this has been a story that we have been selling for a few years now. Every year we start off with a bang, things slow down, then we hope for a second half turnaround, and that has been elusive for different reasons. So if this entire slowdown extends into the second half of the year, we don't think market is pricing that, and then we'll see a more sharper downturn in the markets after that happens. So even I think our bottoms up numbers are assuming some kind of a recovery in second half. I would watch out for liquidity. I think that's the most important measure here. If we have seen liquidity turn surplus for the first time after many months in early June, If that sustains, then I think the chances of improvement in economy in second half are more relevant and more possible. But if liquidity remains tight or turns again into a kind of a deficit mode, then FY20 might turn out to be much weaker year than anticipated.
Okay, fair enough. So when we're talking, about some of those concerns with regards to liquidity persisting for a while, what would you be doing with your selection among the financial basket?
So we will basically stick with the high quality private banks, which have very strong liability franchise. We had now a negative call on NBFC space for almost a year now. We'll just persist with that view. We will stick with some with the very high quality banks in that. We would also actually play some of the cyclical domestic names, because that is where the government will try to improve the economy by pump priming. So there could be sectors within a space within the entire construction, infrastructure, industrials kind of a basket. We would also be looking at real estate more closely, because government would try to give more incentives to improve situation there, while would actually be more cautious on, say, consumption, which has kind of very elevated expectations and very elevated multiples. So risk to stock prices actually exists the most in these highly priced space, which is consumption.
Yeah, exactly. And within consumption, Inderjeet, considering it's such a large basket, you've got the staples, you've got autos, etc. as well. Would you want to take a break, Inderjeet, to have a sip of water maybe? Yeah, okay, you're already doing that. Yeah, so, given how large a basket is it?
Fine.
Yeah, where is it that you think that the first signs of a revival may come by? Because, if I just take a case in point, say something like a Britannia or a Marico or Dabur, some of these consumption names are already seeing a buying coming in from the lows. They had a bad Q2, they had that volume downtick coming in, but again on the declines they have been being nibbled in on at least. So where, according to you, do you think at least somewhere that value is approaching? I know autos could be well far behind, but at least within staples or paints, etc., do you see some opportunities coming in?
So if I look at staples, we still think that more cut in numbers is warranted. Markets, we have seen some buying from the lows is because of the hope that whatever correction we have got is now the great buying opportunity, and this downturn is very short-lived. It doesn't look like, I think we'll get another couple of quarters of pain, and maybe there is a better opportunity to kind of buy into these names at that point of time. In terms of turnaround improvement in actually volume numbers, you might see that first happening with autos as the pre-buying starts to kick in towards the second half. So it will kind of potentially, that could be one space which could be in a contra call right now. We would definitely be interested in looking at the all space, the entire space which is dependent on this whole home improvement, home building kind of a space. So some of the paint names, as you suggested, could actually be interesting because their pricing power, activity will pick up on the real estate or continues to pick up. Most of the data seems to be suggesting that. So from that perspective, actually I would stay away from staples and look at some of these other sub-baskets within the entire consumption basket.
Okay, fair enough. Let's also talk, when you were discussing earlier, when you were looking at industrials, energy, real estate, Inderjeet, what are the parameters by which you're going about selecting some of those names? Just, for an investor who's also looking for opportunity and looking to get into some of these pockets with hoping to get kind of multifold returns going forward. How would you go about identifying the stocks? Any particular ones you want to share with us?
Sure. So if I look at first look at the industrial space, we are looking at companies which have clearly some kind of a moat or an advantage capturing the early brownfield investments. So the companies which are dependent more on or can benefit more on the small ticket maintenance or refurbishment kind of a capex. So these kind of industrial companies could benefit. The companies which depend entirely on very big ticket private capex will basically stay away from that. If I look at on the construction infrastructure side, we are more keen on diversified construction plays rather than single sector focused companies like road segment, because we're still worried about financing in that space. Companies which are not taking too much of a balance sheet risk, obviously that would be a very, very important marker for selection of stocks, given NBFCs are going to remain in a bit of bother for another 2 to 3 quarters. Financing to some of these tier 2 companies can continue to remain constrained. If I look at even within the real estate, clearly companies operating in the mid-income housing, especially in tier 2 cities, I think those kind of companies will definitely look at. Another way is to look at companies with strong commercial or rental portfolio. So that would be another important marker for us to look at selecting companies within the real estate space.
All right, Inderjeet, we'll leave it there. Thanks so much and for sharing, an in-depth look at your portfolio as well. Good chatting with you this morning.
Thank you.